This solution walkthrough is based on problem 1.3b from your textbook. It's meant to help you complete your assigned activity, which is problem 1.3a, also from your textbook. I suggest that you remember three key things as you work on the solution. Number one, the accounting equation. Assets equal liability plus owner's equity. Assets are items of value that are owned. Liabilities represent claims against those assets. Essentially, liabilities represent debt. And the owner's equity is the difference between the amount owned and the amount owed. Notice also that we can expand the basic equation to include revenue and expenses. Revenue will increase the equity of the firm, and expenses will decrease that equity. And so the expanded equation is assets equal liabilities plus owner's equity, and revenue would be added to equity and expenses would be deducted. The second thing you want to bear in mind is that you have to choose sides in accounting, because the perspective makes a difference as to how a transaction will be recorded. Quick example: if I purchase something from a business, for me it's a purchase, for the business it's a sale. And so how that transaction is recorded depends on whether we're recording it from the point of view of the purchaser or the seller. So choose sides. And point number three, at least for chapter 1, is to remember that for every transaction that you're recording, you will either need to add to an account or subtract from an account. And so you have to determine what accounts you need to use to properly record the transaction. In this problem, all the accounts you need have already been identified. You just need to select from the list. So under assets, we have cash, where we record money that comes into the business and money that goes out. Supplies, where we record the purchase of supplies and the use of supplies, if any. Prepaid insurance is the type of asset where we are planning to use insurance, but we are paid ahead of time. And then the equipment, of course, is an asset that we would have purchased to use in the business. On the liability, library would be an asset account that we use to record books or items of that nature that would be used in the business. On the liabilities, we have one account, accounts payable, and then we have an account for the owner, which in this case is P. Schwartz. And we have an account, a temporary account used to record monies taken out by the owner for personal use. And then, of course, as I said, we have revenue and we have expenses. The solution that I will share with you will identify the specific names for the various expenses. However, you will not be required to record that as part of your assigned activity, which is problem 1.3a. So let's take a look at each of the transactions quickly and how the transaction gets recorded. First of all, we have Schwartz, and he's the owner, or she deposited $25,000 into a bank account in the name of the business. So there are two entities involved here. There is Schwartz and there is the business. So the business is the perspective that we are recording every transaction from, and so we ask ourselves, what happened for the business with regards to this transaction? The answer: the business received cash of $25,000, and that represents the investment by Schwartz, the owner, in the business. So we need to record the receipt of the money and the fact that Schwartz, the owner, now has a claim as the owner against that asset. And so in our report, we record an increase in the asset, specifically the cash account, for $25,000. And we record that the owner, P. Schwartz, has invested $25,000 in the business. So the asset side increased by 25, and the liability and equity side, specifically the equity, increased by 25. So the accounting equation is in balance. The second transaction involves purchasing office equipment on account. On account means on credit from Quip Company for $9,670. Again, we quickly analyze. We notice that the business is purchasing office equipment, so they are receiving the asset, the equipment, and it's on credit, so the business owes Quip Company $9,670. And that's what we need to record. And so we show that there is an increase in a specific asset called equipment for $9,670. And since we purchased it on credit or on account, we show that there is an increase in our liabilities for $9,670. By the way, do not focus on the balancing or the equality of the equation. That will take care of itself if you correctly record the transaction. So I'm not going to do the review of the equality of the equation each time we record a transaction. Let's move on to the third transaction, which is C. In this one, we have the owner investing his personal law library, which cost $2,800. And so again, from the perspective of the business, we will note that the business is receiving the books, the law library, and that the value of what the owner put into the business, the value of the books, is $2,800. And so this is another investment by the owner in the business. This time it's not cash, as in the case of A. It is in kind, the law library. And so we record that by showing an increase in the library for the value of the books, which is $2,800. And since this investment was made by the owner, we show an increase in the equity for $2,800. The next transaction is D, where there is the payment, the office rent for the month, $1,700. Again, the business paid out cash. And why did they pay the cash? For office rent. And so we need to show that the business reduced its cash and what the money was used for. The rent is a cost of doing business, and so we're going to record that as an expense. And so in the report, we're going to show that cash went down by $1,700, and that what we did was to increase our expenses by $1,700. Remember, expenses decrease your equity, so technically this $1,700 increase in expenses is really a reduction in the owner's equity of the same amount. We're moving on to transaction E. And in this case, we notice that the business is purchasing office supplies for cash, $418. In your analysis, you would then determine that the business gave up money, cash, and in exchange for the cash, they received office supplies, something of value that they're now going to own. And so in the report, we record that our cash went down by $418, and in exchange we received or increased our supplies $418. Notice in this case that only assets were affected. One asset went down, cash, and another asset, supplies, increased by the same amount. F, the business bought insurance for 2 years, $944. So the business is using its cash, $944, and they're paying for insurance. But notice, this is for 2 years, so they're going to be owning this insurance policy for a while. And so we're going to record this as an asset since it's not yet used. And so in our report, we will show that our cash decreased because the business decreased its cash. They paid out money, and in return, they now have an asset prepaid insurance that would have increased by $944. We're going to keep going. And now we are at G, where the business is selling or providing its legal services. So they're not selling a product, they're providing a service. And so revenue is earned whenever you either provide a service or you sell a product. So in this case, they have earned revenue because they provided the service. It was in exchange for the service that they provided, they received cash of $8,518. And so we are going to show that the business received an increase in its cash and what the money was received for. It was received for services provided, which is revenue. And so we show that our cash went up, increased by $8,518, and that revenues increased by $8,518. Again, remember, revenue will increase the owner's equity, but for now we are recording it in a separate account called revenue. We move on to H, where the business paid the salary of the part-time receptionist, $1,820. Cash is involved, specifically the cash of the business went down because they paid. And what did they pay for? They paid for the salary, which is a service that was provided by someone other than the business, and so it's an expense. And so we're going to record that the cash went down, decreased by $1,820, and that our expenses increased by $1,820. Moving right along, we have the receipt and payment of the telephone bill for $388. So they are spending money. The business is spending $388. What are they spending it on? They're spending it on the telephone bill, which means that they're paying for a service that was provided by an outside entity. So it's an expense. So we're going to record that our cash went down, decreased by $388, and that the telephone bill would increase our expenses or decrease our equity. And so the cash goes down, a decrease, subtraction, $388, and we increase our expenses by $388. We then have the receipt and payment of the bill for utilities, so another expense. This time it's for the utilities, and the amount paid was $388. By the way, note that if they did not pay the bill right away, but they received it because they did use the utilities, we would still record the expense, but we would not record a reduction in cash. Instead, we would show that we now have a liability for $368. However, as I said, in this case, the bill was paid, and so we're going to record the expense as well as the reduction in cash. So notice that we have a reduction in the cash, $368, and we also have an increase in expenses equal to $368. Our next transaction involves the business again providing its legal services for cash, $9,260. And so we're going to record the receipt of cash, which would be an increase in the cash for the business. And since they provided a service, we need to show that their revenue increased from the provision for that particular service. So we show an increase in cash for the amount of the cash received, and we also record an increase in revenue equal to that amount. We're almost there. Hang in there with me. We have transaction L, where the company, the business, is making a payment on account to Quick Company for $2,670. Remember Quick Company from the earlier transaction where the company bought the equipment on credit? So now they're making a payment against the amount that is owed. So we're going to show that the business paid cash or reduced its cash by $2,670, and that the money was used to apply to an account for which they owe a balance. And so we show in our records that our cash went down by $2,670, and that the liability, the debt that we had, decreased by $2,670. So before we owed a total of $9,670, and with that payment our total debt is now at $7,000. The last transaction is where Short, remember he's the owner, or she, not sure who, what the gender is, withdrew cash for personal use, $2,500, and the withdrawal was in the form of cash. So the money of the business, the cash of the business, goes down by $2,500. And since the money was withdrawn for personal use, it's actually a reduction in the capital of the business or the owner. However, we put it in a temporary account and we refer to it as drawing. And so the cash is going to be decreased by $2,500, and the capital, the drawing of the company of the business is going to be increased by 25, but that account, the drawing account, is used to reduce the capital of the business. Notice after all the transactions have been recorded, we can verify that our accounting equation is still intact. Here we have the left side of the equation totaling $45,802, and we have the right side of the equation also totaling $45,802. In other words, total assets of $45,802 is equal to total liabilities of $7,000 plus the total equity of the owner of the business.